And welcome to the Beyond the Dollar Sign podcast with Mark Taylan. Mark, it's good to see you.
Hi, Bill. Great to see you as well.
We're going to talk about something on the table today that a lot of people, I think, probably avoid thinking about, don't want to talk about. It's the dreaded I word,
Uh-huh.
insurance. But insurance is really important. Whether you want to think about it or not, you probably should, especially if you leave your job and you lose whatever life insurance you may have there. If you've not thought about buying insurance, what happens if you pass away, and what happens to your family in terms of their lifestyle, and what happens to them after you're gone? So it's an important topic, and it really bears some conversation. And for those of you who think it's a little squeamish, stick around, because if you don't know Mark, he makes a very easy conversation, and he lays the case out very nicely for talking about the topic. So, Mark, don't let anybody down. I've just given you a build up.
Pressure's on. Thank you. It's a topic that it's not just insurance. It's really about death, right? People
Yeah.
have this perception, especially when they're younger, that they're invincible. And today I really want to talk about this because most clients we work with a lot of clients that tend to be closer to retirement, and they've had experience with this. But I think it's an important topic that I want to talk about is life insurance, and specifically today, term insurance. So, and term insurance really isn't, it's not an investment. It's really about protection for your family.
Exactly.
And so what I think is really important for, I would say, the younger generation. Younger generation now is, I would say, in your 20s, 30s, 40s. It's important to make sure that you check the box here. And so when we're talking about term insurance, we're talking about what is a policy that's only good for a certain amount of years. Term policies can be anywhere from 10, 20, 15, or 30 years, or 25 years. And so there are different terms that you can choose. Now, when it comes to term insurance, it's really, you have to go through an underwriting process. So the premium is determined by a couple things. Number one, how old you are. Two, your health is a key factor. Mm-hmm. The amount of the term policy, and the number of years you want to be protected. So it's really something that I got exposed to early on, and I'll share a story today about this a little later on, about my own experience with term insurance and some families that I've run into where term insurance could have made a huge impact, and where, after meeting with me, term insurance made a tremendous impact. So I'd like to talk a little bit about that today. So
yeah, I'm familiar with term insurance, as most people probably are. A lot of people, if they're fortunate, get a term insurance policy through their employer. They have an option to check in, get a discounted rate on doing that. I've also worked as a freelancer, and I understand the importance of acquiring some term insurance for protection for my family, not for me, obviously. So yeah, and should I buy? The question that occurred to me at one point in my working life is like, should I supplement my employer's insurance policy with one of my own? So I'm throwing those questions on the table for you to explain to us, please.
I think it's a great question. And I think one of the things that I would ask somebody is, if something happened to you today, you got unexpectedly, were gone, how would your family survive without your income? How would they pay the mortgage?
Right.
And potentially, if you've got a young family, you've got young children, what about the dreams you have for your children? And how long could your family sustain without you and your income? Because insurance really isn't about, if you think about a young family with children, in that case, money doesn't, your biggest asset typically isn't your house or your investments. Right. It's really your ability to earn income for the next 20 to 30 years.
Exactly.
So when you ask the question of how much insurance should I have, should I supplement what my work gives me? Most employers give you a multiple of your salary. you know, you just use some round numbers here. Let's say that you make $100,000 a year, and that
Mhm.
typically will be a multiple of that salary is what they provide for you in coverage, which would be 100,000, let's say 2 to 3x. So maybe you've got 2 to 300,000 that the employer helps subsidize the cost of that. And maybe you pay a small portion of your check towards that, but they supplement the rest. You need to sit down and think, if I passed away today, let's use 300,000 as that number. How long would that money last for my family? Would they be able to pay the mortgage off? You know, what would be the monthly income if it was cut in half? If you're the primary wage earner, which I've seen as well, what about that? What if
Mm.
your spouse doesn't bring the income and you were the primary wage earner? Is
Yeah.
$200,000 to $300,000 enough? And so it really comes down to planning and figuring out, how much do you really need? So to your question, I would say that the typical 1 to 2 to 3 times your salary isn't enough. And so I think that people really need to sit down and look at, you know, what does that scenario look like? Typically, when we're doing insurance planning, or where I've seen it is, you plan for a number of years of income to continue. So if you've got a salary of 100,000, maybe you need 5 to 10 years of income. What if you've got a mortgage that's $500,000? That's $500,000 to pay off the mortgage. That's a huge expense, a monthly expense for the household. And so, and what about college as well? So, you know, when you kind of bundle all of those potential expenses, the month to month cash flow, I would say 2 to 3 times your salary probably isn't enough.
It's interesting. Now, there are
Yeah.
a lot of different insurance terms to get thrown around. In fact, we're throwing one around right now, term insurance.
Mhm.
Maybe, we should take a little detour for a second and have you explain what term insurance is versus permanent or any other type.
Yeah, I get that question asked a lot. And term insurance really is, it's fixed for a certain period of time. So let's say I'm in my 30s, I want a $500,000 policy. You go through the underwriting process with the insurance company, and let's say that that's going to cost you $75 a month for the next 20 years. So you're covered
Yeah.
for a 20-year term at $75 a month. Fascinating in that your premium never goes up. As long as you make those premium payments of $75 a month, you've got 20 years of coverage at $500,000. Pretty straightforward, right?
Yep.
When you think about that term policy and you compare that, and people say, well, in 20 years, I've spent tremendous amount of money in that time frame. And if I live beyond the 20 years, the policy is gone. And that in fact is true. And so one of the things that and people ask, well, what about permanent insurance? What about a
Mm.
policy that never expires? The difference between a permanent policy and a term policy is, the permanent policy will continue, yes, for the rest of your life, or as long as you continue to make those payments. However, the premiums on those policies can be 3 to 4 times the amount that
Mm.
you're paying. So that $75 now becomes 200, $300 a month for that period of time. So I would think about, when you think about a young family and things are tight, you're building your
Yeah.
assets. That's a lot of money to put towards insurance. Not everybody can do that. So really, it comes down to, I think, a matter of the monthly expenses in the household budget. Term insurance, in my opinion, you get the most leverage, and what I mean by that is, if the amount of money that you're putting into a term policy for the amount of coverage that you have is really leveraged, in the sense that if I was paying $75, in 2 years from now, I would have paid, what is that, $1,800 in
Yeah.
premiums, and I passed away, my family would have a $500,000 check at the doorstep in within a matter of 20, 30 days.
Wow.
So if you think about that leverage of, how much you've paid into it, and what that benefit is to the family, it's really, to me, it makes sense to put that protection on, in place.
Now, I've heard a term that I'm not familiar with called conversion. What is conversion?
Yeah. So here's another. Some of these term policies have the ability to convert to a permanent policy in the
Oh,
future. So we'll use the 20-year example. And
Okay.
let's say that, and it's going to vary from company to company, but let's say you've got a 20-year term policy, but in the first 15 years, if you want to convert that to a permanent policy, you can. The caveat is that the premium will go up
Okay.
based on that time frame. But the other thing about the conversion that I really think is beneficial is when you do a conversion, the insurance companies are not requiring you to re-underwrite, meaning that,
Ah,
let's say 15 years from now, like all of us, as we get older, we tend to have health issues.
yeah.
And let's say that you're uninsurable. I've seen that as well. And the fact that you've got a term policy that maybe is going to expire in 5 years, you got 15 years into the policy,
Yeah.
and you're going, I really want that benefit from my family. What are my options? And so the ability to do conversions is a tremendous benefit to a term policy. Again, check with your advisor, check with the insurance company, but you definitely want to see if conversion makes sense. And if you think of it from a standpoint of you're younger and you're going to underwrite really well, the younger you are,
Yeah.
typically the lower the premium is. And so you're getting the policy. It's best to get this as you're younger, because
Well,
then you're
that's the
locking
catch
in lower.
22 on all of this, though, Mark, isn't
Yes.
it? I mean, really and truly, because I remember talking to a life insurance salesman when I was in college. So I had to have
Uh-huh.
been about 20 years old, right? And the life insurance guy was saying, well, this is really important for your future. And I'm like, sitting there 20 years old, I'm thinking, I'm never going to die. What do you, if I, and I don't think I can do this later. I could, and now, having lived a little bit of life, I look back, I realize I could have, boy, oh boy, if I had have bought a policy then, my payments would have been so low compared to what they would be, 15, 20 years later from that conversation.
Mhm. Yeah, that's a great point, Bill, because I'll share a story with you. When I was 19, I already had my son and my wife, and I got exposed to insurance early on. And I always
Okay.
worried about if something happened to me, what would happen to them. And so at
Yeah.
19, I had $100,000 policy and went through the process and of doing the underwriting, and it cost me $19 a month. I mean, $19 a month wasn't a lot of money, but in the 90s, right? It was $19. So I had a
Yeah.
$100,000 policy, was good for I think it was 20 years at that time. But my motivation is I wanted to make sure that if something happened to me, they had something, they had an amount of money to be able to continue in
Sure.
my absence. And so I always think back to this time frame because, when you're in the early years in young families, I remember a neighbor of ours, very similar, Mike and Katie, very similar in age, had two young children, two young boys, and they would actually even babysit my son. I was talking to him about that earlier today. And I remember you would, like you said, you would never, you've got the mindset of invincibility. You're in your early 20s. What's going to happen to you? You're healthy, you're active, but, you know, unexpectedly, a few years later, we found that Katie had a stroke and passed away. They found her
Oh,
unconscious in the bathroom. And so, it's something that I'll never forget. And my wife and I talk about that all the time. It's like, you remember Mike and Katie, and what would have happened if they had the foresight at that time to, have a policy,
sure.
and so, in situations like that, people really don't think about, especially, gosh, to $19, you can barely buy a combo meal today, right? It's not much, it's not that much money
It's
to
true.
protect your family, and people don't think about that. And so, it's one of the things that's really important, dear to me, is, certainly we work with a lot of people in retirement that have grown assets, but for those that are just starting out, I'm just an advocate of making sure that you check that box. You have a responsibility when you have family, and you definitely want to make sure that they're protected and can live on in your absence.
If I were a client who came and sat down with you, Mark, and said, you asked me about insurance, and I said, no, I don't have any, and but this conversation is making me think about maybe I should. Can you give me a checklist in terms of, what you would ask me and what you would encourage me to do?
Yeah, it's the same process, and I'll tell you another story where I met a client in their 50s. And one of the early on things that I do is an audit of beneficiary audits to make sure that the
Hmm.
beneficiaries on their and policies are in
Yeah.
place and they've got the estate planning docs in place. And one of the exercises that we do is we make sure that, we're looking at the big picture. And one of the things that I had talked about this couple about was, what are their dreams of retirement? What's the time frame? And let's take a look at the assets and let's take a look at your liabilities. And one of the things I discovered right away with this family was I said, look, you're doing great and you're saving and you're on track. But if something happens to either of you, you've got a significant amount of debt in your mortgage. And so what I said to them is, look, in your 50s, certainly you're not going to get the same level of premium. It's not going to be as cheap as it was if you got it
Right.
10 or 15 years ago. But I think you've got some exposure here. You've got some exposure because your mortgage is still significant. It's over, almost a $500,000. And you're in that window of being, less than 10 years to retirement. I said,
Hmm.
that two things I see is I see you're on track, but the other thing is there's some exposure here if something happens to either of you. And they listened to that and they went and got a term policy. And I remember the husband saying to me, Mark, I hate to give blood. I just hate to do it. And I'm the same way. And I totally empathize with him. But I said, listen, I'm the husband. I said, listen, this is for your family. And whenever I have to go and draw blood, I think the same thing. This is for them.
Yep.
And he did it. He went and got a policy right away. He was motivated to do it. He went and did that. And unexpectedly, I would have never thought. I would have never thought this would happen. Getting ready to retire, unexpectedly passed away.
No.
And it was heartbreaking to me to see that, but he did. And I tell you what, just the matter of doing that exercise of making sure that things were in order and identifying that insurance was the gap
Hmm.
made all the difference in the world. I tell you, from that standpoint, the family was able to eliminate all the expenses, all of the bills were gone. And it was mission accomplished. It was very gratifying for me to see them have to have that asset to be able to put them in that position. So that's one of my stories that I often think about when it comes to term.
That's very effective. That is very, very effective. So, what should I do? I'm listening to this. I'm listening to you talk, and I'm thinking, what do I do? What steps should I take immediately?
I think it starts with a conversation with your significant other or
Hmm.
or yourself and thinking about what would happen to me if I was gone. Who depends on my income? And so I definitely recommend that people talk to an insurance agent. We also write insurance as well. We're happy to help and do the exercise with you. But I definitely think that discussion needs to be had sooner than later. You don't want to get to a point where you've thought about it and all of a sudden, what happens if you're not insurable? That's another risk too, right? If you've got some health issues and you become an insurable. So what we recommend is really to ask the question, have those conversations. It's not a very complex topic. It's very easy to figure out what the number and the need is, and then
Hmm.
and move forward
Well,
with
how do I
that.
do that? Give me like 3 points that I should get. What are the 3 things you would recommend that I do right now if I'm
Right now,
listening to you and I'm
yeah.
convinced?
Right now, I would go if I don't have insurance, I would go to my significant other and say, if something happened to me today, could we make it? And what is
Right.
and then I would sit down and do the expense, look at the mortgages and say, if I
Mm.
was gone, could you handle this? How long can you sustain paying all the expenses? And that's how you first determine that number. The
Yep.
second thing is that you need to go and find an insurance agent or give us a call and figure out what does it cost? How much coverage do we need and how much is that going to cost a month? And you can get an idea. The
Yep.
third thing is you got to go through the process of underwriting and figure out how those numbers work and figure out how much coverage do we need. One more point is if you have a lot of expense, if you have a lot of times clients of mine had insurance when they were younger. And so again, as they've gotten older, they've paid off the mortgage. So the need for term insurance isn't really there anymore for them. But really, if you think about it, it's protection for that period of time
Yeah.
where you have children that have not gone to college, maybe if that's a goal of yours, or you have a mortgage. So for certain, you need to sit down and do the work and do the analysis.
Great. And remember, life throws curveballs all of the time. All of the time. I'm sure you and I could share various stories about you. In fact, you have shared a couple of stories where there were curveballs. I'm sure people listening have seen a few curveballs in their lifetime as well. And that's really what we're talking about today, isn't it, Mark? We're talking about protection against those curveballs to kind of, ensure that your family and the people you care about, your loved ones, are protected.
That's right.
Yeah. So if anybody's listening to this conversation, Mark, and would like to have a conversation further with you about this topic, what is the best way for them to do that? How do they reach out to you?
Yeah, give us a call, 408-778-8280. Our information's in the show notes. We'd be happy to have a conversation with you.
It's fantastic. And I want to emphasize this in the show notes because some of you may be listening to the podcast where you're driving a car, maybe taking a walk, and you don't have a pencil or anything to write things down with. It's there. Don't worry. You can go there after you get back and you have time to write it down. And I would encourage you to, in fact, reach out to him. The other thing I would encourage you to do is just hit the follow button if you're not a subscriber already, because by becoming a subscriber, every time Mark drops a new episode, you're notified. You can give it a listen. And if you find these topics interesting, if you find these conversations of interest, I would ask you to please share it with people. Tell people about it. Let them know, because word of mouth promotion is the most invaluable tool that we have today. So until next time, I'm Bill Tucker. On behalf of Mark and everybody at 360 Advisors, thank you for taking the time to listen today. And we'll catch you next time. Thank you for listening to Beyond the Dollar Signs Financial Clarity. Click the follow button to be notified when new episodes become available. Visit our website at advisors360pwm.com or give us a call at 408-778-8280. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Advisors 360. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. ECA does not provide tax or legal advice. Guest opinions are their own and may not reflect those of ECA. The viewer is encouraged to seek their own individualized tax and legal advice from a qualified professional.